Okay, let's dive right in. We're talking about the loan-to-value ratio, or LTV. Now look, it's a term that, well, if you're in finance, you probably think you know it inside and out. But what if I told you that the simple math we've all relied on for years is basically becoming an illusion? In this explainer, we're going to break down why your actual borrowing power is probably a lot less than you think.
And this quote right here, it just hits the nail on the head. For high net worth folks, borrowing seems pretty straightforward, right? But the reality is that idea is getting more and more disconnected from what's actually happening. The old rules, they are becoming dangerously outdated, especially for sophisticated borrowers with significant assets.
All right, so before we can really get into what's happening now, we've got to take a quick step back. Let's talk about the old LTV rulebook. You know, the simple math we all thought we knew. I mean, look, on the surface, it's dead simple, right? It's just arithmetic. You take your loan amount, you divide it by what the asset's worth, and voila, there's your LTV percentage. So a 7 million pound loan on a 10 million pound asset, that's a 70% LTV. Easy, clean, predictable. Or at least that's what we thought. Okay, but here's the thing. That calculation, it's not the point. And honestly, if you're still stuck on that simple math, you are completely missing what's going on. The calculation isn't wrong, but it's just not the most important piece of the puzzle anymore. Not by a long shot.
So that leads us to the real game changer here, the big shift in thinking we all need to make. We've got to stop thinking like we're the borrower and start seeing the world through the lender's eyes. Because for them, LTV isn't just some number on a page. No way. It's their number one tool for managing risk. And here's what's so crucial to understand. A lender looks at LTV and they see a safety net, a buffer. It's the cushion they have in case your asset's value takes a nosedive. Think about it. A 70% LTV means they have a 30% buffer. And in a crazy, volatile market, that buffer is everything. And guess who decides how big that buffer needs to be? Yep, they do.
And that's exactly what's happening right now. Lenders are demanding bigger and bigger buffers. Now, this isn't just happening out of nowhere. There are actually three major forces at play that are squeezing LTVs and reducing your leverage. So what are they? Well, for one, credit conditions across the board are just tighter. Everybody's being more cautious. Two, asset values are all over the place. They're way more volatile, which means lenders feel they need more protection from any potential downside. And three, their own internal rulebooks, their risk frameworks, have gotten way stricter. They're running stress tests for worst-case scenarios now. Okay, I know this all might sound a little abstract, so let's make it real. We're going to walk through three scenarios where you can see this clash, the borrower's old school expectation versus the lender's new, harsh reality. Okay, scenario one. Let's call this the concentrated position. Picture this, a high net worth individual who owns a really big, valuable chunk of a private company, and they want to borrow against that stake. So, the borrower is looking at this huge valuation on paper, and naturally they're expecting a pretty generous LTV. But the lender, they see a totally different picture. They see one thing above all else, illiquidity. Their big question is, hey, if this all goes sideways, how do we sell this asset quickly to get our money back? And the answer is, they can't. So what's the result? A way lower LTV than our borrower ever dreamed of. Because for the lender, the ability to sell, the liquidity, is way more important than the on-paper valuation.
All right, for our second scenario, let's switch gears. We've got a family office. They have a nice, big portfolio of stocks and bonds, liquid stuff. This should be a slam dunk, right? Well, maybe not. See, the family office is thinking as long as our portfolio value stays above this line, we're golden. But when the market gets choppy, the lender starts to get nervous. And here's the key. They don't wait for things to go wrong. They act before there's a problem. They'll proactively chop down the maximum LTV they're willing to offer just to give themselves a bigger safety cushion. And for the borrower, that can mean a sudden margin call or finding out they can't draw down the funds they were counting on.
And for our last case study, let's talk about commercial real estate. We've got a property developer, they have a prime commercial building, and the appraisal came back looking great. So the LTV should be fantastic, right? Well, not so fast. Because the lender's credit committee isn't just looking at that appraisal. They're looking at the whole market, rising interest rates, maybe a glut of similar properties coming online. So even if that building's value is solid today, they're obsessed with what happens tomorrow if the market comes under stress. What's the liquidity then? Their core concern is that downside risk. And so they lower the LTV, leaving the developers scrambling to find more equity. Okay, so after hearing all that, you might be feeling a little nervous. But here's the good news. Knowing this stuff is a huge advantage. It lets you get ahead of the game. It's time to throw out the old playbook and adopt a new one. All right, so here it is, your new playbook. Let's really drill down on this. Number one, ditch the maximum LTV. Forget about it. Whatever rates you see advertised are just bait. They are not what you're actually going to be offered. Two, focus on liquidity. I can't say this enough. How quickly and easily your asset can be sold is what lenders are really thinking about, sometimes even more than its sticker price. Three, recognize fragility. You have to understand that a higher LTV makes your whole financial world more fragile, more sensitive to any little market tremor. Four, anticipate change. Your borrowing power today is not your borrowing power tomorrow. It's not a fixed number. It's always in flux. And finally, the golden rule. Number five, think like a lender. At the end of the day, your LTV is determined by their comfort with risk, not by your expectations. And all of this really boils down to one final crucial question you have to ask yourself. Is your financing strategy built on an old, comfortable guideline, or is it built for the new reality where LTV is a real tightening constraint? Because honestly, how you answer that question could make all the difference in the world.